Hello and welcome to this important chapter, risk analysis in capital budgeting. Now we are going to revise this chapter and take some important questions, right? So write down risk analysis in capital budgeting. Revision. One day before the exam, you can just revise this much, okay? So first we have to understand expected value. Expected value means average or mean. Average or mean. So how do you compute it? Expected value will be equal to sum of the observation multiplied by probability. Observation can be cash flow, observation can be cash inflow, cash outflow. For example, if you have to compute expected cash flow, then you will take summation of cash flows multiplied by their probability. Is it right? So that gives you expected value. Then we have seen the formula of variance. Variance means deviation of data from the mean. Deviation of data from the mean. Higher variance means higher deviation. Higher variance means higher deviation and higher risk. So how do you calculate variance? Variance is equal to sum of x minus x bar square into p. And what is x bar here? Expected value, which we have calculated above. And what is p here? Probability. And then we calculate standard deviation. Standard deviation is the square root of variance. It measures risk. Okay, it is a measurement of risk. Higher standard deviation means higher risk, and lower standard deviation means lower risk, and vice versa. Lower standard deviation means lower risk. So standard deviation is equal to under root variance, or directly under root summation x minus x bar square into probability. Is it right? So these are called statistical technique for understanding the risk. These are the statistical tool for evaluation of risk. Then the fourth concept we have seen is coefficient of variation. Coefficient of variation. In short, CV, it measures risk per unit of return. It measures risk per unit of return. It measures relative risk. On the screen, it measures risk per unit of return and it is useful for measuring relative risk. So we use the concept of coefficient of variation when we have to compare two or more projects. Useful for comparison two or more projects. Useful for comparison of two or more projects when risk and return are different. When risk and return are different. Is it right? So formula is coefficient of variation is risk divided by return, or more specifically standard deviation divided by expected value. Okay. Higher the CV, higher the relative risk. Higher the CV, higher the relative risk, and vice versa. Between two projects, one with lower CV, between two projects, one with lower CV will be selected. Is it right? If the risk and reward both are different, compute CV and the decision will be based on CV because it gives you lower risk per unit of return. What is the reason? You want to write reason because it gives lower risk per unit of return. That is coefficient of variation. The fifth concept in this chapter is called risk adjusted discount rate, RADR. Risk adjusted discount rate is short called RADR. Here higher discount rate is used for projects with higher risk and vice versa. Vice versa means lower discount rate is used for project with lower risk. Is it right? So how it is calculated? So one formula is risk adjusted discount rate is risk free rate plus risk premium or RF plus beta into RM minus RF, or RF plus beta into RM minus RF. RF means risk free rate, this is beta, and what is RM? Return on market portfolio. return on market portfolio. Return on market portfolio. The third is sometimes institute will give you the discount rate directly. Is it right? The institute will give you discount rate directly. How many concepts we have read? 5. The sixth concept in this chapter is certainty equivalent coefficient. Certainty equivalent coefficient is called CEC. Is it right? Here, uncertain cash flows are converted into certain cash flows by multiplying by certainty equivalent. Please write. I am making a small summary of this chapter for you, which will be required a day before exam. Uncertain cash flows are converted into certain cash flow by multiplying by certainty equivalent coefficient. Okay, so you will be given risky cash flow. You convert into risk-free cash flow and then write down apply risk-free discount rate. Apply risk-free discount rate to calculate present value. Apply risk-free discount rate to calculate present value. Okay, formula. First formula is CEC formula. Keep writing if you are interested candidate. Genuinely interested. Okay. Otherwise, watch the show. Certainty equivalent coefficient equal to formula. Certain cash flow divided by uncertain cash flow. We'll solve a question in next few minutes. Then I will further explain with the help of number. Or second formula, certain cash flow equal to CEC multiplied by uncertain cash flow. Then write down range of CEC. What is the range of CEC? Between 0 to 1. 1 indicates certain cash flow. 0 indicates highly uncertain cash flow. Highly uncertain cash flow. So investment in government bond has a CEC of 1. Loan given to Daud Ibrahim. Gangster Daud Ibrahim, not normal person, okay? I hope he does not watch my video. Otherwise, your remaining syllabus will not be completed. You will take pen drive. But you have to record it, na? So this is CEC. Is it right? Next concept we have learned. How many concepts are there? 6, 7. sensitivity analysis. So what does sensitivity analysis does? It measures the impact of change in a variable on NPV. It measures the impact of change in variable on NPV. Also, it measures by what percentage, a variable must change to make NPV 0. By what percentage a variable must change to make NPV 0. Okay. Then write down sensitivity percentage will be equal to change divided by base. Change divided by base. Then write down in sensitivity analysis, we change one variable at a time keeping other variables constant. Keeping other variables constant. We change one variable at a time keeping other variables constant. Okay. Eighth, write down scenario analysis. Scenario analysis. So it is a little advanced version of sensitivity analysis. Here we calculate NPVs under different scenarios. We calculate NPVs under different scenarios. The scenarios can be worst case, most likely, and best case. Right. Here we change more than one variable at a time. Here we change more than one variable at a time. Thus, it helps us to identify the risk associated with the project. Thus, it helps us to identify the risk associated with the project. Is it right now? So, based on this discussion and some example that we will take, you will be able to understand this concept again fully. So, on all these concepts we will take some examples, then you can understand even better. Are you ready? Louder, yes. Yes. So please come to question number 9 in our book. Our class note is a comprehensive book covering all question of study material, RTP, MTP, exam, covers all varieties of question also. Question number 9. 10 mark question. Can you see that 10 mark question? November 2020 exam. Are you ready? Say yes. This question is very, very important. Pre-practice is required. Okay. Pre-practice means you have to practice in advance. And with the help of this one question, we will practice standard deviation, we will practice expected value, we will practice variance, we will practice coefficient of variation also. So one question will help us with so many concepts. Shivam Limited is considering two mutually exclusive proposal A and B. Project A cost 12,000, project B cost rupees 11,000. You have been given the below and net cash flow and probability for each project. So you are given following cash flows with their respective probabilities. So do you know how to get the expected value? Yes, sir. You will multiply and add them. Summation cash flow into probability. So first you multiply, then summation. So that will give you expected cash flow, and this will fetch you, let's say, 2 marks. Just multiply, add, you get 2 marks. What more do you want in life? Compute the risk attached to each project. Risk means standard deviation. You have to calculate for both the projects. So we'll practice standard deviation. Compute the profitability index of each project. Calculate the profitability index of each project. Identify which project do you consider, which project will you recommend. State with reason. Have you studied profitability index in earlier chapter? Formula. PV of cash inflow upon PV of cash outflow. Okay. And which project would you recommend and why? So that we will see later. Okay. So let us solve one by one. First we will write down step 1, calculation of expected cash flows. Go according to the question. Write down in step-by-step manner. Question is from study material and exam. This question is also in the study material. Calculation of expected cash flows. We will draw a table with the following columns. Under that we'll draw total 6 columns. Project A will have 3 columns and project B will have 3 columns. Keep calculator ready. The columns will be cash flow, probability and expected cash flow. Again, cash flow, probability and expected cash flow. Write nicely. Avoid short forms. For getting full marks, write full. If you want half, write half. Choice is yours. I will give you column number also. 1, 2, 3 will be 1 into 2. 4, 5, 6 will be 4 into 5. So that in future when you revise again, you'll understand. So cash flows are 15,000, 12,000, 10,000, 8,000 and probability is 0.4. Keep writing use calculator, learn to solve faster because exam gives you very limited time. Paper is very lengthy. Very few people are able to complete 100 marks. Is it 6,000? Memory plus. Next one. Memory plus. Keep adding in memory. Memory plus. 800. Memory recall. 12,400. Wonderful. Project B question book in front of you. 15,000, 12,000, 10,000, 8,000. Is it right? And then probability is given 0.3, 0.5, 0.1, 0.1. Yes. 4500 memory plus. 6,000 memory plus. 1,800 total. This total is called expected cash flow. 12,300. This is 12,300. Any query on this question? No query. Now write down step 2, calculation of standard variance and standard deviation. So that you learn variance also and standard deviation also. Calculation of variance and standard deviation. Again we'll solve in one table only. Project A, 3 columns, cash flow, probability. In cash flow column write here X, in probability column write P, and the last column write X minus X bar square into P. And what is X bar equal to? Expected value of A, which is here 12,400. Can you see that? So every time you have to deduct 12,400. I hope with lot of practice you will be able to do it faster also. And then we have project B, same 3 columns. First you write down cash flow. This time you write Y just to differentiate. Probability write P, and here you write down y minus Y bar square into P. So again copy the 2 columns from the booklet. 15,000, 12,000, 10,000, 8,000. Correct? Probability 0.4, 0.3, 0.2, 0.1. So how do you get this column? I will help you. 15,000 type on calculator minus 12,400 into equal to into 0.4. So you are getting 27 lakh 4,000. Okay, one more chance. 12,000 minus 12,400 into equal to into 0.3. 48,000. 10,000 minus 12,400 into equal to into 0.2. 11,52,000. 8,000 minus 12,400 into equal to into 0.1. 19,36,000. Total. This total is called variance. Variance. So that is 58,40,000. And right below standard deviation equal to, just in the same column, under root 58,40,000. So you can write here, you can write below. I don't have it. 2416.61. Okay, this is good enough. So this way you present the answer. If you don't have space, write below. Any query on project B? A? No. Now we'll try project B. What is your cash flow in the question book? 15,000, 12,000, 10,000, 8,000. Cash flows are same, but probability is 0.3, 0.5, 1.1. And what is y bar here equal to? It means expected value of project B. Y bar is expected value of project B on the screen below, right side, 12,300. 12,300. So you will take 15,000 minus 12,300 into equal to into 0.3. 21,87,000. Wonderful. Next. 45,000. Very good. Next. Do the calculation and then tell me. Is right. Okay. Next one. 18,49,000. Total. This is total is called variance. Total is called variance. Total is how much? 46 lakh 10,000. And then below that write down standard deviation is equal to under root 46 lakh 10,000. Square root of variance is called standard deviation. 2147.1 approximately write down. So first question was compute expected cash flow, we have done. Compute risk attached, that is standard deviation, that also we have done. Okay. What is the third question? Profitability index. Since you are a highly talented student, you will find and tell me. Student will reply this answer. Profitability index of each project. Step 3. Calculation of first chance to the student. Profitability index. Yes, who will reply for project A and who will reply for project B? First you try, then give me the answer. 1.03 project A. 1.03. 1.03 project A. 3. 1.12. So for that we need what is the PV of cash inflow? 12,400. This will get from step 1. 12,400 and second one was 12,300. Assuming this cash flows given to you are in present value terms. Okay. This question has a small mistake. What is the mistake? They have not mentioned cash flows given are in present value terms or not. But there is no discounting factor. So we can assume they are already in present value terms. Point number B. PV of cash outflow, which is given in the problem first paragraph. 12,000 is for project A and 11,000 for project B. So therefore profitability index 1.0 formula A upon B 1.033 and 1.118. You can write 1.2 12. Wait, one more line, right? Step 4. Calculation of coefficient of variation. Yes, their cash flows are different. You see on the screen, cash flows are different, standard deviation are different. Okay. Project A, project B. So coefficient of variation is equal to standard deviation upon expected value. Standard deviation upon expected value. Standard deviation of project A, previous answer, step 2 answer. Project A on the screen, 2416.61, this figure. 2416.61 and expected value is 12,400. Answer in points, answer in decimal. 0.1948. Second one, the standard deviation is here on the right side below, 2147.1. 2147.1 and it is 12,300. 0.1745. Now you can answer better. If you look at the profitability index, project B has a higher profitability index and it has a lower coefficient of variation. It has a lower coefficient of variation and it also has a lower standard deviation also. So there are three good reasons why project B should be preferred. Okay. So write down recommendation or advice. Project B should be preferred. Project B should be preferred because A, B has higher profitability index. B has higher profitability index. Then write down B has lower standard deviation. B has lower coefficient of variation. So it has lower risk. So it has lower risk. Is it understandable? Yes, sir. So this question was for 10 marks. And if you go prepared in the exam, you can score 10 marks. It won't take much time also. Okay. So in this question, expected value, standard deviation, variance, coefficient of variation, profitability index, all formula got tested. Good question for exam purpose, they should again ask. Now we'll come to November 2022 exam question for 5 marks. What is the question number? Question number 34. Determine the risk adjusted NPV of the following projects. So this question will help you with risk adjusted NPV. So the concept of RADR will be used here. There are three projects ABC: net cash outflow, project life, annual cash inflow. Coefficient of variation is given, means risk per unit of return is given. The company select the risk adjusted discounted on the basis of coefficient of variation. Underline, company adjusts risk adjusted discounted on the basis of coefficient of variation. So if the project has 2.2 coefficient of variation, which means it is greater than 2, it will have discount rate of 25% because it has a higher risk. Higher CV indicates higher risk. So they are using a higher discount rate because project A has a higher risk. 1.6, where is 1.6? Here. So what discount rate we will use here? 18%. And project C has a lower coefficient of variation, means lower risk. 1.2, so this is 1.2. And what discount rate will use for this project? 16%. And to help you, your Ultra Kind Institute has given you the PV annuity factor also. So you just have to multiply these factors with this cash flow, get PV of cash inflow, deduct the outflow, and that will give you NPV. Which project should be selected on the basis of risk adjusted NPV? So the decision will be based on NPV. The one which has higher NPV will be selected. Bonus mark. I will tell you, this is a bonus mark. Just one table and you get 5 marks. Write down. Calculation of risk adjusted NPV. Calculation of risk adjusted NPV. Right hand side 3 columns. Project A, Project B, Project C. Done. Draw the format first. Good student will write everything in detail. So can we start now? If you allow me, write point A, net cash outflow. Copy from the question book. 70,000, 1,20,000 and 2,20,000. Do you agree? Right. Point number B, write down coefficient of variation. Coefficient of variation. Under that you write down 2.2, 1.6, 1.2. So that will help us to identify the risk adjusted discount rate. Point number C, risk adjusted discount rate. Risk adjusted discount rate. So how much is that? Will you take 25, 18 and 16. Then write down annual cash inflow. Annual cash inflow. 30,000, 42,000 and 70,000. Wonderful. Now write down PV annuity factor. PV annuity factor for 1-5 year. Already given in the question. This is already given in the question. 2.689, 3.127, 3.274. Yes or no? If you multiply D and E, you will get PV of cash inflow. Come on, PV of cash inflow. Multiply D into E. Yes, who will give me the answer first? 80,670. Come on, next one. Next one. 131,334. Come on, next one. 229,180. 229,180. Are you there? Last line, NPV. E minus A. Right? E minus A. E minus A. A. E is inflow, A is outflow. So on your calculator, 10,670, 11,334, 9180. 9180. Are you getting it? Very good. This way you will present the answer nicely. If the question asks you which project you will select on the basis of risk adjusted NPV, these are the risk adjusted NPV. So your answer will be that project which has highest NPV. So write down the decision. The company should select project B. Come on. The company should select project B. Company should select project B because expected NPV is highest. Because expected NPV is highest. Because it has highest expected NPV. Now you get 5 marks for this much effort. So this was an example on RADR, risk adjusted discount rate. Any query on this? If no, why are you sitting idle? Go to question number 13. One practice we will do on certainty equivalent coefficient. Okay. So this will revise your certainty equivalent coefficient. Question number 13. Geary Limited. Which limited? Geary is using certainty equivalent approach in the evaluation of risky proposal. The following information is given. Year 0, 1, 2, 3, 4, 5. Cash flow CE. Riskless rate of interest on government security 6%. What will you do with that? What will you do with that? Answer that. Don't repeat my question. We'll use it as a discount rate. Okay. Determine whether the project should be accepted. First we'll check NPV. If NPV is positive, accept. Source of this question is study material. Repeated in November 18 RTP and similar question in 2020 May RTP. So what should we do? Solve? Yes. Right. Write down the heading calculation of NPV. Calculation of NPV. Give question number 13 in our book. All varieties are covered. This will be asked in your exam also. First column write year. Second column write cash flows. In bracket uncertain cash flow. This will be multiplied by certainty equivalent coefficient. You will get cash flows which are certain. Certain cash flow will be discounted by the risk-free discount rate which is 6%. So present value at the rate of 6%. Directly we will calculate present value. Is the factor written in the question book? Factor at 6% is not written? Not written. Factor is not written. Rate is written. Column number 1, 2, 3, 4. 4 is 2 into 3 and 5. Then you copy the first 3 columns from question as it is. Only for adding 2 extra columns You are getting marks. What more do you want in life? Year 0, copy from the book without any changes. 0 is 4 lakh. Yes or no? Please write down also in your own interest. This question is in your study material also. We are trying to ensure that you cover maximum number of questions, maximum varieties of questions. You do lot of practice. You get confidence and you pass the exam. That is what I aim for. But then you also have to work little hard. These 3 columns are given. Certainty equivalent indicates 0.8 indicates that if 1 rupee is uncertain cash flow, I am willing to accept 80 paise certain cash flow. So we will multiply and convert into its equivalent certain cash flow. That is the meaning of certainty equivalent. Come on. 2,56,000. Is the student right? Is the student right? 1,96,000. Others will check. 1,56,000. Very good. Come on, everybody. 96,000. Yes, very good. 48,000. Now take your calculator. First write 4 lakh in bracket. If you don't have factor, then you can do it directly on calculator. Also use memory plus function. Type 2,56,000 divide by 1.06 equal to memory plus. Try again. 2,56,000 divided by 1.06 equal to, anybody? 2 lakh 241,509. Okay, memory plus 1,96,000 divided by 1.06. 2 times equal to 174439. Memory plus. Come on, next. 13,981 memory plus. Next one. 041. Very good. 48,000 divided by 1.06. 5 times equal to 35868. 35868. So this method reduces your effort and there is no rounding off problem also. Memory recall minus 4 lakh. 2,58,839. 258. This is NPV. NPV is 258. Then write decision. Would you like to write decision on your own? What is the decision you will write? Since NPV is positive, accept the proposal. Is it right? Since NPV is positive, and also write it increases the wealth of the shareholders. It increases the wealth of the shareholders. It increases the wealth of the shareholders. Okay. Now we'll come to question number 32. This question is on sensitivity analysis. Question is from May 22 exam. For how many marks? 5 marks. Write down important again. So I will read the question from your book. The question is in your book. P Limited is considering a project with the following details. Initial cost is 1 lakh. Annual cash inflows 30,000, 40,000, 50,000, 60,000. Life 4 years. Cost of capital 10%. Measure the sensitivity of the project. 2. Changes in initial project cost. So this is a problem on sensitivity analysis. Okay. So first factor you have to test is project cost. Second, annual cash inflow, considering each factor at a time, such that NPV becomes 0. So two factors you have to test. And in this case, you have to apply sensitivity analysis in such a manner that what should be that cost of capital, cost of project, not cost of capital, project cost, and what should be that annual cash inflow at which NPV will be equal to 0. So you have to do reverse working and find out that value. This is a 5-mark question. To help you, they have given you present value factor also. One last line, identify which of the two factors the project is most sensitive to affect the acceptability of the project. So we have to find first percentage sensitivity. The one which is lower, project is more sensitive to that variable. But first thing first, calculation of NPV, year, cash flow, PV factor, at what rate? At 10% and present value. Listen to me and then write. 1, 2, 3, write down. 3, 4. 1, 2, 3, 4. Are you there?
Yes, sir.
Or you have gone in sleep mode?
No, sir.
30,000. Keep mobile in sleep mode. You don't go in sleep mode. 50,000. 60,000. Factor you copy from the book. Year 0 I will write below. Don't worry. 0.909. Any other presentation is welcome. Don't worry. 0.826. If you are taught some other presentation, you follow that. Okay. 0.683. Now, learned student will kindly reply the last column. 50,000 into 0.909. 27270. Very good. 33040. 37550. 40980. Wait, so this will be called PV of cash inflows. Yes or no?
Yes, sir. NPV is
So how much is this?
38840.
Total of this, please tell me. 138,840. Then write down less initial investment. Less initial investment. How much is that? 1 lakh rupees? 1 lakh. So what you get? Therefore NPV. 38840. So this is positive NPV. Original estimate gives you positive NPV. If original estimate itself is negative, there is no need to do sensitivity analysis. Any query on this calculation? So first always you do the NPV calculation on the basis of the original data, original estimate. Now you have to see what is the question. Major sensitivity of the project to change in initial project cost and annual cash inflow. So you have an NPV of 38840. Your initial project cost is 1 lakh. If this number 1 lakh becomes 138,840, your NPV will become 0. So therefore, I have a margin of safety of 38,840. if the initial investment cost increases beyond 38,840, then the NPV will become negative. So write down step 2, sensitivity analysis. With respect to initial project cost. Use the same terminology which the question uses. Okay. So you just write a note for your understanding. If initial project cost increases by, I will write on the next page, by 38,840, the NPV will be 0. The NPV will be 0. Therefore, sensitivity percentage equal to NPV divided by initial project cost. This you can apply in every problem for initial project cost sensitivity. So you will get 38,840 and divide by 1 lakh into 100. So you will get 38.84%. Is it 38.84%? Step 3. Step 3, sensitivity analysis with respect to annual cash inflows. Now this is again on the screen. Strategy of presentation. The PV of cash inflow is 138,840. Yes or no? If I reduce this number by, if I reduce it by 38,840, suppose this number reduces by 38,840, what will happen to NPV? NPV will become 0. So this is our margin of safety and this is the base. So the answer will be 38,840 divided by 138,840. So that is why I first got this answer in this format. Easy for me to explain and easy for you to understand. Got it? So write down sensitivity percentage equal to NPV divided by present value of cash inflows. So you have 38,840 divided by 138,840 into 100. 27.97%. Which is lower? The second answer is lower. So write note, project is more sensitive to annual cash flows. Project is more sensitive to annual cash flow because here if it falls by 27.97%, NP will be 0. But here if it rises by 38.84%, then NP will be 0. So here a small percentage change can lead to negative NPV. So relatively the project is more sensitive to cash inflow. Is it right? Now we'll come to one question number 25, May 19 exam for 5 marks. This question is based on scenario analysis. Okay, 5 mark question, bonus marks, as if they are trying their best to pass you, push you, but still you are adamant that you like intermediate so much. Question number 25, Kanuria Enterprise wishes to evaluate two mutually exclusive projects X and Y. Mutually exclusive means acceptance of one will lead to rejection of other. We have to make a choice between X and Y. Initial investment is same, 1,20,000 each. Estimated cash inflow per annum for 8 years. For 8, underline 8 years for calculation of NPV. You will use 8 years. And there are 3 scenarios. Future can be pessimistic. Pessimistic means worst scenario. Okay, if everything goes wrong, your cash inflow for project X will be 26,000, but Y will suffer more. It will have only 12,000. Most likely scenario, both will give you same cash inflow, 28,000. But in the optimistic scenario, best case scenario, X will generate 36,000 rupees per annum, but Y will generate 52,000 per annum. So in the worst case scenario, X is giving you higher cash inflow. In best case scenario, Y. Let us do the calculation, then we'll discuss. Cutoff rate is 14%, means discount rate. Factors at 14% given to you. So you will use these factors and solve. Advice means you have to answer whether X or Y will be selected. About the acceptability of the project X and Y. So very good question. One by one we'll solve. Write down calculation of or in same table should I solve? Okay, same table. Calculation of NPV of two projects. It will save time under different scenarios. Serial number, particular, then project X will have 3 columns and project Y will have 3 columns. Which 3 columns? Pessimistic. Most likely means average, and optimistic. Everything is going great. Okay. Rahul Gandhi becomes Prime Minister. Priyanka Gandhi becomes Home Minister. Raghuram Rajan becomes RBI Governor again. Mamta Banerjee becomes Defense Minister. So everything going good. That is optimistic. Okay. Arvind Kejriwal becomes Foreign Minister. Whatever you think. So let us solve this amazing question. First point A, write down cash inflows per annum. Cash inflows per annum. You have to answer. Project X pessimistic 26,000. Project X most likely. Project X optimistic. Project Y pessimistic. Project Y most likely. Project Y optimistic. Is it right? Easy to understand? Then you write down point B. PV annuity factor at 8 years 18 and 14%. So what you do, just please calculate the total of those factors given in the booklet. Don't use own factor. Take the total of the factors given in the booklet. Anybody wants to volunteer? Anybody for 4.639? 4.639. 4.639. Just add those 8 numbers. Now you don't apply extra intelligence, okay? Simply you have to add. And then you get PV of cash inflows. It will be A into B. So multiply A into B, come on. 1,20,614. Very good. 129. Very good. Next one, 129,892. Try again. 167,004. Then next one, 55,668. 129,892. Next one, 241, 228. Any question on this? The answer should flow in such a manner easy to understand. So point number D, write less initial investment. In both projects it is 1,20,000. So that you write in all columns, because that you will incur today. So that is not affected by future uncertainty. Okay. So that is point number D. So what will be point number E now? NPV, C minus D. Come on. 614, 9892. Without calculator you can try. 47004. Without calculator you can try. 332. This is negative. Then next one is same 9892. Last one is a very big number, 121.
121, 228.
Okay, you are too late. I have already done. Now, in this question, you have to reply which is better. If you look at project Y, it may generate a negative NPV, but project X will generate positive NPV. We don't have to take average because either it will be this or this. Either it will be pessimistic or most likely or optimistic. You can't assign probability. It is a question on uncertainty. But if the optimistic scenario prevails, X will have lower NPV, but Y will have a very high NPV, which is almost not 5 times. Approx, Nalai. Who gave you the license to become an intermediate student? 2.57%, and you are saying approximately 5 times. Which country do you come from? Which planet do you come from? Don't be in a hurry. So now I am asking all the students a question. If you are sitting on the decision making chair, which project you will select? Will you select X, which will give you positive NPV in all the three cases, or project Y, which will give you negative NPV in pessimistic scenario, but can generate a very high NPV in the optimistic scenario, which is almost 2.5 times of the project X optimistic scenario. So tell me, you have to take a decision. The human being should know one thing which makes them different from an animal. They can take decision. Is it right? Quickly, 5 seconds more. X or Y?
Y.
One student will prefer X. Yes, come on, next.
Y.
One student says he will prefer Y. And the answer is both of you are right. The one who wants to take a high risk for a high return, is it right? He can go for Y. Like people like you are risk taker only. Do you know that? You are also living under three scenarios. Pessimistic, optimistic most likely. Pessimistic you can understand after so many years of course. Suppose it should not happen, but for hypothetical discussion doesn't pass. Student, suppose there are students in library, you will find they have almost become father of two sons, but they are still in final. So they are here. They are still trying because he knows that if I pass, I will generate a very high NPV compared to other ordinary human beings in this country. Is it right? Otherwise, everybody would have done BCom only. Then why will people come to CA course? Because in optimistic scenario, if he passes in first attempt with rank, his NPV will be very high. But it also carries a very high risk. So risk taker will go with project Y and risk averse investor will go with project X. Write down decision. This time the decision is not either X or Y, it is dependent on risk taker. So write down decision. I will dictate. Write down. Write down, listen to me and write down. Project X gives positive NPV. Project X gives positive NPV. Project X gives positive NPV in all the three scenarios. Project X gives positive NPV in all the three scenarios. Okay. whereas project Y whereas project Y whereas project Y may generate whereas project Y may generate negative NPV in pessimistic scenario. Therefore, the decision will depend upon the attitude the decision will depend upon the attitude of the investor towards the risk. The decision will depend upon the attitude of the investor towards the risk. Next paragraph. If investor does not want to take high risk, if investor does not want to take high risk, he will select project X. He will select project X. Next paragraph. If the investor is willing to take high risk, if the investor is willing to take high risk for a high return, in bracket optimistic scenario, in optimistic scenario, if the investor is willing to take high risk for a high return in bracket in optimistic scenario, he will select project Y. He will select project Y. And the world is full of such people, okay, who knows that there is a risk, but they take that decision, they take that chance. Is it right? They take that chance. They know that there can be losses, but then they take such chances. So this question cannot have one answer, only project X, because human beings have different attitude towards the risk. When you watch a Kaun Banega Karodpati program on TV, you will find there are two types of contestants. One who says, sorry sir, I don't know the answer, I would quit, I will take whatever money I have earned and I will go home. But there are people who knows that he is taking the risk, but he knows that if I give a right answer, from 50 lakh I will move to 1 crore, but I can lose also. But then why does he reply to the answer even though he is not very confident? Because he wants to take risk and knowingly that he may incur the losses also. If everybody would have taken same decision in the same scenario, then everybody would have quit. Is it right? But no, people take risk and some people want to reduce the risk. So that was the answer of this amazing hand. Wonderful question. So now we'll go to next question. So come to one more important question, number 2020. Question number 20. A&R Limited has undertaken a project which has an initial investment of rupees 2000 lakhs in plant and machinery and 800 lakhs in working capital. Understood? 2000 in plant, 800 in working capital. The plant and machinery would have a salvage value of 474.61 lakhs at the end of the 5th year. So good question. The plant and machinery would depreciate at the rate of 25% per annum on WDV basis. Oh my God, this is going to make your life miserable. because the WDV method means every year you have to do separate working. The other details of the project for the 5 year are as follows. Sales selling price per unit, then variable cost is 50% of selling price, fixed overhead excluding depreciation 300 lakhs per annum, corporate tax rate 35%, rate of interest on bank loan is 12%, and after tax required rate of return is 15%. So which discount rate will I take? I will take 15%. This is my after tax required rate of return. So we will use required rate of return, desired rate of return, target rate of return for NPV calculation. Is it right? Then what is the question? Similar question we have already done in capital budgeting chapter. Compute the NPV of the project and determine the viability of the project. Okay, determine the viability of the project. Then after that, up to this the life was simple. Determine the sensitivity of the project's NPV under each of the following conditions. Decrease in selling price by 10%. So this time they have given you find the revised NPV assuming selling price will decrease by 10%. And by what percentage NPV would change? Understood? And then we have increase in the cost of plant and machinery by 10%. Now this increase in cost of plant and machinery also means your depreciation will also change. Understood? And these are the factors at 12 and 15. 12% is not required. Delete. This is given to extract money from poor students. Poor in the sense, not financially, intellectually. Okay. Some of them will take average also. Possible. Anything is possible in our country. So let us solve. How do I solve? You have sales, selling price, then 50% of the selling price means 250. So question is very easy. It will only take a little more time to solve because of the WDV depreciation. If it was straight line method, the life would have been easier. Say yes. Yes. So write down calculation of NPV. Calculation of NPV. NPV. Right. Format. First step, calculation of NPV. Good question. May 2020 MTP 10 marks. So first write down serial number, particulars, then you write year 0. How many years are there? 5. Year 1, year 2, year 3, year 4, year 5. Presentation can change, but the answer should remain the same. So first point number A, Cost of project. How much is the cost of this project? Anybody? Cost of the project? 2000 lakhs. Cost of the project is 2000. Yes, rupees in lakhs, write down. In bracket 2000 in year 0. Point B, write down working capital. Working capital is how much? 800. This also write in bracket. Point number C, write down sales quantity. Sales quantity in lakhs. So read the problem. In the table, sales quantity 10 lakh unit per annum is written. So you write down 10, 10, 10, 10, 10. Then point number D, write down total contribution. Now understand the problem. I will save some space. 500 is the selling price, 50% is the variable cost. So contribution will be 500 minus 50%, 250. 250 is the contribution into quantity. Into quantity. Into quantity. So my question is 250 into 10 you have to do. 250 into 10, 2500. That is contribution. Point number E. Do we have any fixed overhead also? Yes. Less fixed overhead. So fixed overhead will remain fixed only. That is how much? 300. 300. 300. 300. 300 and 300. One more line, write down less depreciation. Method is WDV. Method is WDV. What is the cost of the project? 2000. Rate of depreciation 25%. WDV or straight line? Is it WDV? Yes. So what you do, dear student, 2000 into 25%. 2000 into 25% is how much? 500. Then what you do, if the depreciation rate is 25%, next year you multiply 0.75 into 500. 0.75 into 500 is how much? Now just press equal to, you will get the next year answer. 281.25. Again press equal to 21. Exactly 211. Tell me in two digits. 210.94. 210.94. Again press equal to. 158.20. Either you round off all the numbers or you round off in two digits. Okay. Follow consistency. Any query up to this. You can present in different format. This is simple mathematics. Contribution minus fixed cost and minus depreciation. What will you get? PBT. Write down PBT. Depreciation I have already deducted. So you have to take your calculator. 2500 minus 300 minus 500. 1700. So you write here D minus E minus F. Later on you should not forget, huh? Anybody? 1825. Okay, next. 1918.75. Very good. 1989.06. Very good. Next one. 2041.80. 2041.8. You're getting? Point number H, write down. Less tax at the rate of. What is the tax rate in the problem? 35%. Wait, I will tell you how to get it fast. First you take 0.35 into 1700. Now just type the PBT and press equal to 638.75. Next year 671.56. Next one 696.17. 696 point, only two digits on last one. 714.63. Okay, wait. Point number I, write down CFAT. So CFAT will be, listen to me, G minus H plus F. G minus H will give you PAT. PAT plus depreciation CFAT. So 1700 minus 595 plus 500. 1605. Very good. 1825 minus 638.75 plus 375. 1561.25. Okay. Next one. 1528.44. Very good. Next. Next one. 1503.83. Last one. Please try. 14. 1485.37. Point number J, write down. Salvage value. So salvage value of the project is given.
Yes, sir. 474.61.
Which year?
This year.
That is 476 point.
474.16.
Yes, that in the last year. One more point, right? K. Recovery of working capital. Recovery of working capital. This 800 will be recovered here. Is right?
Yes, sir.
Now you draw a line first. L, write down. Therefore, cash flow. Therefore, cash flow. Year 0 outflow is 2800. Okay. But for the other 3 years, we have to add these 3 numbers. Am I right? So 1605, 1561.25, 1528.44, 1503.83. These 3 you add. Last 3 figure add. How much you are getting? 2759. 98. These are the cash flows of these years. Done? Please check. Answer is not over. You have to compute the present value. So point number, how many points we have written? L, right? M. PV factor at 15%. Year 0 will be 1. Year 0 will be 1. 1 will be 0.869. Year 2 will be 0.756. 0.657. 0.571. 0.497. And write down present value. L into M. So first will be same. How much? 2800 negative. Anybody for year 1? 13.75. Then 1180.31. Okay. 1004.18. Very good. 858.68. Very good. 1371.71. So therefore NPV equal to, now you will add all these numbers in the last line. Kindly add.
NPV 3010. 3010.
Approximately 3010 lakhs. 3010 lakhs. Note, write down. Note, as the NPV is positive, the project is viable. As the NPV is positive, the project is viable. Any query on this? Now the question is, determine the sensitivity of project's NPV under each of the following condition. So one by one we'll do. Decrease in selling price by 10%. So write down sensitivity analysis. Step 2. Sensitivity analysis with respect to decrease in selling price by 10%. Decrease in selling price by 10%. Is it right? Right hand side, write down rupees in lakhs. I'll just make your calculation little simpler. Okay. So first you write down reduced selling price. What will be reduced selling price? 500. Wait, minus 10%. Why are you making calculation which even a rocket scientist will require? 500 minus 10% is the reduced selling price. No, you were saying some other thing.
For years now, there is no
Less variable cost. So variable cost will also accordingly be 50% of 450. Yes or no? How much? 225. Wait a minute. In the institute answer, they have not adjusted the variable cost. So we will take the same. Only the selling price may change. Material cost may not change. Is it right? So we'll take 250 only. Bracket assuming no change in variable cost. Because what happens? Only selling price can change, but raw material cost, labor cost may not change. So point C, contribution is equal to how much? 200 rupees A minus B per unit. Point D, total contribution is 10 lakh quantity into 200. So now you write in this column 2000 rupees in lakh column. Point E, write down less fixed overhead, that is 300. So point F, write down PBDT. PBDT. So up to this the format is same. So why to write in all 5 years same thing again and again? Yes or no? Up to PBDT my answer will be same. So we can save time by first just finding PBT. Now write down step 2 or whatever. No, this was step, make it 2A because it is related to same answer. Make it step 2B. Calculation of NPV. So write down first column year, second column PBDT, third column depreciation, fourth column PBT, fifth column, can I write tax pad directly? How? Okay. I'll multiply by 0.65 or let it be, we will write tax only, otherwise many students will get confused because they are used to writing tax. Then you write down PFAT, PV factor given in the problem, then use it, and last column PV, present value. Similar problems you have done in capital budgeting chapter. Okay, so I will write column number also for more clarity. Column number 1, 2, 3, 4 is 2 minus 3, 5, 6 will be 4 minus 5 plus 3, 4 minus 5 plus 3, or you can say 2 minus 5, or you can say 2 minus 5. 2 is inflow, 5 is outflow, whichever helps you to do faster. Okay, and then column number 7, 6 into 7. So let us write down here 1, 2, 3, 4, 0 I'll write later, 1, 2, 3, 4, 5. PBDT previous step 1700. Can you see 1700? So I have solved in two formats. One the original answer and one this answer. Then whichever one you find it easy, convenient, less time consuming, and depreciation you copy from the previous one. Do you remember depreciation was 500? Same as original answer. Depreciation will not change. 281.25, 210.94, 158.20. Step now 1700 minus 500, 1200. Very easy. Next one, 1325. Next one, 1418.75. Next one, 1489.06. Next one, 1541.80. What is the tax rate? 35%. Okay. Type 0.35 into 1200. 420. Then just type 1325. 463.75. Very good. Next. 496.56. Very good. 5 to 1.17. Very good. 539.63. Now CFAT, either you can take column number 2 minus column number 5. That I think will be easier. 1280. Okay. 1236.25. Okay. 1203.44. Okay. 1178.83. Very good. 1160.37. Factors if given in the problem, copy 0.869, 0.756, 0.657, 0.571, 0.497. Triple one 2.32. Okay. Use memory plus function also, so that you don't have to add again. 934.61. 934.61. 790.66. 790.66. 673.11. Okay. 57.70. And first you tell me the total of the last column. Total of the last column. 37. So this we will call PV of cash inflows. There are two more cash inflow. One is salvage value and one is recovery of working capital. Is it right? Just check the total again.
409.
Kindly check the total again. I can't take the responsibility for mistake in total. Four zero 4087.4. So PV of cash inflow. Then to that we'll add PV of salvage value and recovery of working capital that we'll receive in the last year. How much is salvage value? 474.61. And how much is recovery of working capital? 800. Multiplied by fifth year factor 0.497. So this is the PV of salvage value. Anybody would like to answer? Final answer. 3.49. Now write down less initial investment and working capital. Less initial investment and working capital. So in that case, your initial investment was 2000 in fixed asset and 800 in working capital, in bracket 2800. So now I will get my NPV for this revised selling price.
So 1920.88.
1920.88. This is right. 1920.88. Understood? Original answer was how much? On the screen 3010. By changing your selling price by 10%, your NPV has gone down drastically to 1920.88. So right below, percentage reduction in NPV. Percentage reduction in NPV. So original answer 3010. This answer is 1920.88 and divided by 3010 into 100. Around 36.18%. Oh my god. 10% decrease in selling price will reduce your NPV by 36.18%. Is it right? Now one homework you do. What is the homework? Second part, that is cost of project. Cost of project increases by, or cost of plant and machinery increases by 10%. So the new cost of plant and machinery will be how much? 2000, it was already there, and plus 10%. 2200. So the depreciation will also change accordingly. Is it right? Depreciation will change. Now wait, so you have to go to the original answer. I will first tell you and then you will solve it yourself. Your original answer will have the following changes. I am going to highlight with a red highlighter. This figure will become 2200. Understood? This will, no, I will not solve. You have to solve. I am just telling you. 2000 will become 2200. Can you do that much?
Yes, sir.
then here this depreciation will get affected.
And that TV will be
So
all
depreciation will be, instead of based on 2000, it will be based on 2200. So this figures will change. Okay, and accordingly your subsequent answer will change. And in the last year they have not mentioned about salvage value, so we'll take same salvage value. So only what you do, you have to change this to 2200 original answer and change the depreciation. So accordingly your subsequent answers will change. Can you do that? Because it will just require calculation of same thing with different numbers. Wastage of human time and talent in the classroom. So try this, keep one page blank. This answer is over.